As an entrepreneur, one of the most important decisions you'll make is how to price your products or services. Your pricing strategy can make or break your business. Get it right, and you'll maximize profits and growth. Get it wrong, and you could struggle to attract customers or devalue your offerings. Pricing is a delicate balance. You need to charge enough to cover your costs and generate a healthy profit margin, but not so much that you price yourself out of the market. It's a constant challenge, especially when competing against established players or trying to disrupt an existing industry. This video will explore key principles and best practices for developing an effective pricing strategy. We'll cover everything from understanding your costs and analyzing the competition to choosing the right pricing model and tactics. By the end, you'll have a framework for setting prices that maximize your business's profitability and growth. Pricing determines the amount a customer must pay to acquire a product or service. It is a fundamental aspect of business strategy that affects revenue, profitability, and market positioning. Pricing decisions are driven by various objectives, each with merits and challenges. Profit maximization is often the primary goal, where prices are set to yield the highest possible profit margins. This objective is essential for businesses operating in mature markets with established products or services. Market penetration is another common objective, where lower prices are used to quickly gain market share and customer base. This strategy is often employed by new businesses or those introducing a product or service to a new market. Survival in a highly competitive market may necessitate pricing strategies that prioritize maintaining a foothold over short-term profits. In such cases, businesses may need to match or slightly undercut competitor prices to stay relevant and retain customers. Lastly, maintaining a competitive edge through pricing can help businesses differentiate themselves and establish a unique market position. Premium pricing, for instance, can reinforce a brand's image of quality and exclusivity. Several internal and external factors influence pricing decisions. Internal factors include production costs and overhead expenses. Accurately calculating and allocating these costs is crucial for determining profitable pricing levels. External factors encompass market competition, customer demand, economic conditions, and the perceived value of the product or service. Understanding and balancing these factors is crucial for setting effective pricing strategies. There are several pricing strategies available for entrepreneurs. Cost-plus pricing is a traditional strategy that involves calculating the total cost of production and adding a markup or profit margin to determine the final price. It is a straightforward approach that ensures cost recovery. However, cost-plus pricing may not account for market conditions or the product's perceived value, potentially leading to suboptimal pricing. Put simply, cost-plus pricing is almost always the wrong approach. Value-based pricing considers the perceived value of the product or service from the customer's perspective. This strategy can lead to higher profit margins if the perceived value exceeds the production costs. For example, a luxury watch brand may charge a premium price based on the perceived value of its brand and craftsmanship rather than just the cost of materials and labor. Value-based pricing requires an in-depth understanding of customer preferences, willingness to pay, and the unique benefits of the product or service. In highly competitive markets, entrepreneurs may need to adjust their prices based on the strategies and pricing levels of their competitors. This approach can help maintain market share and competitiveness, but may result in lower profit margins. For instance, a new restaurant in a crowded neighborhood may need to match or slightly undercut the prices of established competitors to attract customers initially. Competition-based pricing requires constant monitoring of competitor offerings and pricing adjustments to stay relevant. A penetration pricing strategy involves setting a relatively low initial price to gain market share and customers quickly. Once a substantial customer base is established, prices can be raised gradually. This approach is often used for new products or services to capture market share before raising prices to more profitable levels. Penetration pricing can be risky, as it may be challenging to raise prices once customers become accustomed to the low initial prices. Price skimming involves introducing a product at a high price, targeting early adopters and price-insensitive customers. As the product matures and competition increases, prices are lowered to attract more price-sensitive customers. This strategy is commonly used for innovative or technologically advanced products, where customers are willing to pay a premium for being among the first to own the product. Price skimming can maximize profits in the short term, but may risk losing market share as competitors enter with lower-priced alternatives. With the advent of digital technologies and big data analytics, dynamic pricing allows businesses to adjust prices in real time based on factors such as supply and demand, competitor pricing, and customer behavior. This strategy requires sophisticated data analysis and pricing algorithms. Airlines and hotels are examples of industries commonly using dynamic pricing, where prices fluctuate based on travel dates, occupancy levels, and demand patterns. Dynamic pricing can be complex, but can maximize revenue by capturing changes in market conditions and customer willingness to pay. To fine-tune your strategy, it is important to understand how your prices impact customer behavior. Pricing has a significant impact on customer perception and decision-making. Customers often associate higher prices with higher quality, while low prices signal inferior quality or discounted items. This phenomenon, known as the price-quality heuristic, can be leveraged by businesses to position their products or services as premium or budget-friendly offerings. For example, a high-end cosmetics brand may charge premium prices to reinforce the perception of quality and exclusivity, while a discount retailer may offer lower prices to appeal to value-conscious consumers. Pricing should align with a brand's identity and market positioning. Premium brands typically command higher prices, while budget-friendly brands offer lower prices to appeal to price-sensitive customers. For instance, a luxury car brand like Mercedes-Benz would be expected to have higher prices than a more affordable brand like Toyota, reflecting their respective brand positions. Inconsistent pricing strategies that deviate from the brand's positioning can confuse customers and damage the brand's credibility. Entrepreneurs must carefully consider how their pricing decisions reinforce or undermine their desired brand image and positioning in the market. Psychological pricing thresholds, or price points, can significantly influence sales volume. For example, a product priced at $9.99 may sell better than the same product priced at $10, even though the difference is minimal. This phenomenon is known as charm pricing, where prices just below a round number appear more attractive to consumers. Similarly, prices ending in odd numbers, such as $7.97, can convey a sense of precision and value, making them more appealing to certain customer segments. Understanding and leveraging these price points can help entrepreneurs optimize pricing strategies and maximize sales volume. To set prices effectively, entrepreneurs must thoroughly understand their fixed and variable costs. Fixed costs, such as rent, insurance, and administrative expenses, remain constant regardless of production levels. Variable costs, such as raw materials and direct labor, fluctuate based on the number of units produced. Accurately calculating and allocating these costs is crucial for determining profitable pricing levels. Gathering data on customer willingness to pay, competitor pricing, and market trends is crucial for informed pricing decisions. Surveys, focus groups, market analysis, and online data mining can provide valuable insights into consumer behavior, preferences, and price sensitivities. Market research can also reveal opportunities for differentiation and premium pricing based on unique features or benefits offered by the product or service. By understanding customer needs and pain points, entrepreneurs can better position their offerings and set prices accordingly. Businesses often serve multiple customer segments with varying needs and price sensitivities. Tailoring pricing strategies for different market segments and distribution channels can maximize profitability and reach. For example, a software company may offer different pricing tiers for individual consumers, small businesses, and enterprise clients, reflecting their respective willingness to pay and usage requirements. Similarly, a consumer goods manufacturer may have different pricing strategies for wholesale and retail channels, accounting for the varying costs and margins associated with each distribution channel. By segmenting the market and tailoring pricing strategies accordingly, entrepreneurs can capture a broader customer base and optimize revenue streams. Prices should not be set in stone. Entrepreneurs must be prepared to adjust prices in response to market changes, cost fluctuations, competitive pressures, and shifts in customer demand or preferences. Regular price reviews and monitoring of key performance indicators can help identify when price adjustments are necessary. For instance, if a competitor introduces a disruptive product or service at a lower price point, entrepreneurs may need to reevaluate their pricing strategy to remain competitive. Similarly, changes in raw material costs or labor expenses may necessitate price increases to maintain profitability. By staying agile and adapting pricing strategies to evolving market conditions, entrepreneurs can maintain a competitive edge and ensure long-term success. While pricing strategies are essential for business success, entrepreneurs must operate within legal boundaries. Price fixing or colluding with competitors to set prices is illegal in most jurisdictions, as it stifles competition and harms consumers. Predatory pricing, or setting prices so low as to drive competitors out of business, is also prohibited, as it can lead to monopolistic practices once competitors are eliminated. Entrepreneurs must be vigilant in pricing practices and avoid any actions perceived as anti-competitive. Consulting with legal professionals and seeking guidance from industry associations can help ensure compliance with relevant laws and regulations. Being upfront and transparent about pricing with customers is crucial for building trust and maintaining a positive reputation. Hidden fees, misleading pricing tactics, or unexpected charges can damage customer relationships and brand image, leading to long-term consequences for the business. Entrepreneurs should clearly communicate pricing information to customers before completing a transaction, including any additional fees or surcharges. This transparency fosters trust, helps manage customer expectations, and reduces potential disputes or misunderstandings. By understanding your costs, analyzing the market, determining the best pricing model, and incorporating tactical pricing levers, you'll be well on your way to setting prices that balance profitability and customer value. Pricing is all about finding that sweet spot, charging enough to sustain a healthy business, but not so much that you price yourself out of the market. It takes experimentation, data analysis, and a deep understanding of your customers. Striking the right balance between profitability, competitiveness, and customer satisfaction is the key to unlocking sustainable growth and long-term success. Thank you for joining us in this exploration of pricing strategies. Please like this video and subscribe to our channel to receive notifications about future videos.